Welcome to the deep dive. Today, we're taking a plunge into a truly foundational framework for understanding market trends and business cycles, the Dow Theory. This isn't just dry history, it's actually a remarkably insightful lens that's still pretty relevant today. Our source material for this deep dive comes from Robert Rhea's 1932 book, The Dow Theory. It meticulously explains William Peter Hamilton's interpretations, which were themselves built on Charles H. Dow's original observations. So our mission today, we're going to unpack this rich historical material, pulling out the most important nuggets of knowledge, and we want to reveal how a theory developed nearly a century ago can still offer some surprising insights into how collective intelligence shapes our economic future. Think of it maybe as a shortcut to seeing the hidden currents in the market. Okay, let's unpack this right from the start. When you hear Dow theory, you immediately think Charles H. Dow, right? But who actually shaped it into the significant framework we discussed today? Charles H. Dow, founder of Dow Jones and Company, editor of the Wall Street Journal. He certainly initiated observations about the stock market, but here's the kicker from our sources. He actually wrote very little on the subject before he died in 1902. So if not primarily Dow, then who? This is where William Peter Hamilton steps in, late editor of the Wall Street Journal. Our sources really emphasize his crucial role. Hamilton authored a whopping 252 editorials between 1903 and 1929.
Wow, 252.
Yeah, and that extensive body of work is considered the actual source material for the theory.
Right.
He wasn't just observing. Hamilton apparently dared to make definite editorial forecasts where Dow didn't. His contributions were so significant, he was even elected to a fellowship in the Royal Statistical Society back in 1923. And then, years later, Robert Rhea came along. He undertook a careful study of both Dow's and Hamilton's writings. Rhea provided a, quote, valuable service by presenting the Dow theory in his 1932 book, specifically in a form designed to help the individual investor or speculator.
What's truly fascinating here is how this theory wasn't, a single flash of genius. It was more like an intellectual legacy built meticulously over decades. It evolved from these initial kind of scattered observations into a more formalized system through diligent analysis and continuous refinement. It really highlights that sometimes the most profound insights come from consistent long-term dedication, not just a momentary revelation.
That's a great point. It's like a slowly developing photograph, isn't it?
Exactly.
So, if this theory took decades to formalize, what does it actually mean for understanding how the market moves? The theory breaks down all market action into three distinct types of movements, almost like different tides of the ocean. First, you have the primary movement. This is the big one, the broad basic trend, what we typically call a bull or bear market. These extend over periods that can vary, less than a year sometimes, or up to several years, and the sources couldn't be clearer. The correct determination of the direction of this movement is the most important factor in successful speculation. That's pretty direct.
Absolutely crucial. Get the main direction wrong and you're fighting the tide.
Right. Now, what's really insightful are the distinct phases within these primary trends. A primary bull market, for instance, typically unfolds in three phases. Think of it like a journey of market sentiment. The first phase is about reviving confidence in the future of business, sort of when the smart money quietly starts to step in. Then comes the second phase, the response of stock prices to the known improvement in corporation earnings. This is when growth becomes more obvious. And finally, the third phase, where speculation is rampant and inflation apparent, a period when stocks are advanced on hopes and expectations.
The euphoria stage, right?
It's a remarkable parallel to human psychology, isn't it? You see that shift from initial, maybe disbelief or caution, to rational buying based on fundamentals, and then that final, almost irrational speculative frenzy. Understanding this psychological arc can be really crucial for an investor. Helps you avoid getting swept up in that dangerous final phase where hope trumps reality. Absolutely. And the bear market has its own three phases, kind of a mirror image of that emotional journey. First, there's the abandonment of the hopes upon which stocks were purchased at inflated prices. The bubble bursts. Then, selling due to decreased business and earnings as the fundamentals catch up or maybe worsen. And finally, the painful third phase. Distress selling of sound securities by those who must find a cash market.
Yeah, that's when good assets get thrown out just because people need cash, not because the asset itself is bad. Forced selling.
Exactly. So if the primary movement is the grand underlying tide, what about the waves that move within it? That brings us to what the theory calls secondary reactions. These are defined as important declines in a bull market or advances in a bear market. Counter-trend moves. They usually last anywhere from a few weeks to several months and typically retrace roughly a third to two-thirds of the primary trend's progress. It's crucial to remember that these secondary reactions are, quote, frequently erroneously assumed to represent a change of primary trend. People mistake them for the real deal.
Right. They see a pullback and panic, thinking the bull market's over, or vice versa.
Yeah. And Hamilton explicitly called them one of the safeguards of a bull market and the most effective check on excessive speculation, like letting off steam.
Healthy corrections.
And lastly, we have daily fluctuations. The theory states that inferences drawn from one day's movement are almost certain to be misleading. Think about how much noise we get from daily market reports, right? It's constant.
Turmoil sometimes.
However, a series of charted daily movements always eventually develops into a pattern easily recognized as having a forecasting value. So the pattern emerges over time.
If we connect this to the bigger picture, understanding these three tides helps you filter out the daily noise. It helps you identify the truly crucial underlying currents. It's about discerning significant shifts from mere ripples, like you said, staring at a single pixel versus seeing the entire photograph. The daily fluctuations are pixels. The primary trend is the whole image.
That's a perfect analogy. It's amazing how this century-old theory helps us filter noise. But how does it help us interpret the signals we do see? The theory isn't just about identifying movements. It provides specific rules for interpretation, especially for predicting future trends. And one of the most crucial principles, something our sources highlight as the most useful part and that must never be forgotten for even a day, is that both averages must confirm. The movements of both the railroad and industrial stock averages should always be considered together. Our sources stress that conclusions based upon the movement of one average, unconfirmed by the other, are almost certain to prove misleading. So why is it so crucial that both averages confirm? What does that tell us about the broader economy, beyond just individual stock prices?
That's a fantastic question, and it really gets to the heart of the theory's practicality. In Dow's era, you had industrials as manufacturing, making things right, and railroads were the arteries of commerce, moving those things. If a steel company's booming, it produces more steel, but that steel also needs to be shipped somewhere. So if railroad activity isn't confirming that industrial strength, it suggests a disconnect in the broader economic engine. Maybe the demand isn't really there, or there are logistical issues. It means the real economy isn't truly reflecting what the stock prices of, say, the manufacturing firms are suggesting. So it's a powerful check on the health and, well, the interconnectedness of the entire business landscape, our production and distribution in sync.
That makes perfect sense. It's about seeing the whole ecosystem, not just one part. The theory also gives clear guidelines for determining the trend from price action, which really boils down to recognizing visual patterns on a chart. A bullish indication is seen when there are successive rallies penetrating preceding high points, with ensuing declines terminating above preceding low points. So higher highs and higher lows. Each recovery goes higher, each pullback stops higher. Simple, visual.
Classic definition of an uptrend.
Exactly. And conversely, a bearish indication is evident when there's a failure of the rallies to penetrate previous high points, with ensuing declines carrying below former low points. Lower highs and lower lows. The market can't get back to its old peaks, and then it keeps breaking down to new lows. Again, very logical, very visual.
The downtrend signature?
Okay. One of the more visually intriguing concepts here are these lines periods where the market just seems to flatten out, go sideways. The sources describe them as fluctuations for a number of weeks within a narrow range, maybe 3% or approximately 5%, over, say, 60 to 90 days. What's truly happening during these phases, and why are they apparently so hard to interpret in real time?
The lines.
Yeah.
Imagine the market hitting a kind of pause button.
Mm-hmm.
During these periods, you've got this hidden battle unfolding beneath the surface. On one side, big players might be quietly accumulating shares, buying up everything available at a certain price range, getting ready for advance. On the other side, they might be distributing them, discreetly selling off their holdings before they expect a downturn. Now, when there are simultaneous advances above the limits of the line, that signals accumulation 1. Higher prices are likely coming. Conversely, simultaneous declines below the line imply distribution. The sellers won that battle, and lower prices are sure to follow. The challenge, as the source notes, is that when a line is in process of formation, it is the hardest thing in the world to tell which is happening, accumulation or distribution. It's this silent, almost invisible struggle, making conviction really difficult until you get that clear break up or down.
That's a brilliant way to put it, a hidden battle. Wow. And speaking of hidden insights, a truly fascinating and profound insight from the theory is that the market discounts everything except the completely unexpected. The idea that the market movement reflects all the real knowledge available, it reflects not the past, but the future. The sources actually call it a passionless barometer, the balance of all the desires, compulsions, and hopes of those who buy and sell stocks.
Passionless barometer. I like that.
Yeah. This means the market, almost magically it seems, discounts this vast array of factors. Business conditions, political actions like Congress's decisions, interest rates, even the seriousness of foreign troubles. For instance, that drastic 1931 decline. It was seen as already pricing in huge events like Great Britain abandoning the gold standard, bank failures, railroad receiverships, things that hadn't fully played out yet.
Right.
However, and this is key, it does not profess to be able to foresee the San Francisco earthquake or an incident like the Northern Pacific corner. So truly random, unforecastable events, the acts of God, are exceptions.
It's like the market is this giant, emotionless sponge, just soaking up every piece of information out there, from whispered rumors in boardrooms to major geopolitical shifts. It reflects all that data, trying to foresee the future, not dwell on the past. The Dow theorists understood that if something is publicly known or even widely speculated about, the market has probably already processed it. It's priced in. It's only the truly unforeseen, the black swan events, that catch it completely off guard.
So it's about what's already known or reasonably anticipated. That also ties into the theory's perspective on manipulation's limits. Hamilton, our key architect here, held that a limited number of stocks may be manipulated, maybe temporarily, but it is impossible to manipulate the whole list or the great market movement, the overall primary trend. The market itself is bigger than all the pools and insiders put together. That kind of goes against a lot of common thinking, doesn't it? The idea that big players control everything.
Absolutely. It's a powerful counter-narrative. While small pockets, individual stocks can be influenced for a time, the sheer scale and sort of collective intelligence of the entire market make it ultimately impervious to widespread, sustained manipulation of the main trend. It reinforces the idea that the passionless barometer is driven by the aggregate actions of countless participants. It's an incredibly robust, ultimately self-correcting system in that view.
That's actually quite a reassuring thought, especially in today's complex markets. Lastly, the theory considers the role of volume. Now, Hamilton occasionally downplayed its usefulness, apparently, but the sources say he repeatedly made use of market activity and volume figures in his conclusions anyway, so he did use it.
Actions speak louder than words, maybe.
Perhaps. The general observation is that trading is heavier in bull than in bear markets. Makes sense. More enthusiasm. Volume also tends to increase whenever new highs or new lows have been made in primary bull or bear markets. Breakouts or breakdowns get attention.
Right. Confirmation of the move.
But there's specific insight here. In bull markets, when volume decreases after a decline, it's often an indication the market is at least temporarily oversold. So how does volume offer that crucial secondary layer of insight? How does it help confirm or challenge the price action?
Well, volume essentially reveals the conviction behind a price move. Think of it as the energy or the force behind the price change. High volume on new highs or new lows suggests strong agreement, strong participation, or maybe strong fear pushing in that direction.
Oh.
But if prices decline in a bull market, like a secondary reaction, but the volume just dries up, it tells you that the selling pressure isn't really strong. People aren't rushing for the exits en masse. Maybe they're just pausing, waiting it out, not panicking. It's a key sign that the underlying bull trend likely remains intact, and the market is simply correcting, not fundamentally reversing. It's about looking at how the market is moving, the intensity, not just where the price is going.
What a fantastic way to put it, the conviction behind the move. That makes a lot of sense. Okay, this deep dive has shown us the meticulous framework of the Dow theory. It's quite detailed. But the sources also offer crucial warnings and really timeless wisdom for anyone trying to apply it, whether that's in finance or maybe even other complex systems. And the first key warning is crystal clear. It is not infallible. The Dow theory is not an infallible system for beating the market, period. Its use requires serious study, and the summing up of evidence must be impartial. No shortcuts, no biases. The sources remind us that mistakes will be made, as it is an empirical science. They even compare it to surgery, where a good surgeon is sometimes wrong.
That's a sobering comparison.
It is, and a particular danger they mention. Beware of beginner's luck. Why do you think they emphasize beginner's luck so strongly? Seems counterintuitive, almost.
Well, it's a classic psychological trap, isn't it? When you first dabble in something complex like this, and you see immediate success, maybe just by pure chance, it can lead straight to overconfidence, this false sense of infallibility. I've got this figured out. And that prevents the serious study and impartial judgment the theory actually demands. You start to believe you've cracked the code effortlessly, when really you just got lucky. And that's often when the true, painful lessons begin, because you take bigger risks based on false confidence. Humility, even when you're right, is absolutely paramount.
That's powerful advice. Stay humble, keep studying. And for anyone looking to truly grasp this, the importance of active study is stressed. It's essential to procure the tabulated prices and properly drawn charts of the daily price movements. Ideally, they suggest drawing your own charts to really internalize how the picture unfolds. It's about getting your hands dirty with the data, not just reading about it.
Absolutely. Kinesthetic learning almost, feeling the patterns yourself.
Right. Finally, our sources offer some truly timeless traders' philosophy and pitfalls that honestly transcend the market itself. These feel like life lessons sometimes. For example, Hamilton's axiom, when in doubt, do nothing. Simple, but hard. Why is this such powerful advice, especially in complex systems where there's pressure to act?
Well, it's a direct antidote to our very human bias for action. We feel this pressure to do something, to constantly intervene, to look busy or decisive. But in markets, and actually in many complex decisions in life, the best decision is often no decision at all, at least until the signal becomes clear. Wait for your pitch, as they say in baseball. It prevents those impulsive moves driven by emotion, fear, greed, impatience rather than clear evidence. It protects your capital, and maybe more importantly, preserves your mental clarity. It requires real discipline, though.
Discipline is definitely key. And then there's this often surprising piece of wisdom from Hamilton. Pride of opinion was more responsible for losses than any other single factor. Pride. Why pride?
Because it blinds you. Simple as that. If your ego gets tangled up with being right about a market call or an investment, you'll start ignoring conflicting evidence. You might double down on losing positions just to avoid admitting a mistake. You fail to adapt when conditions change. Hamilton also stressed learning to take losses quickly and let their profits run. Pride is the enemy of taking quick losses. Holding on to a mistake because admitting it means admitting you were wrong. But the market doesn't care one bit about your pride. It only cares about price and trends.
That's a really profound takeaway. It's not about being right all the time, which is impossible. It's about managing effectively when you're inevitably wrong. Cut the losers, ride the winners.
And just to cap off this deep dive with a historical note, it's worth recalling Hamilton's remarkable final forecast. Published just weeks before his death on October 26, 1929, right before the crash, he famously declared that the major movement of the market has turned downward. Talk about going out on a high note.
Yeah.
Or maybe a low note for the market.
Yeah.
But an accurate one.
A final, incredibly prescient insight. So what does all this mean for you listening today?
This deep dive into Robert Rhea's explanation of the Dow theory reveals, I think, more than just a method for analyzing stock prices. It's really a testament to the power of careful observation, diligent data synthesis, and truly trying to understand the collective intelligence or maybe the collective psychology of a market. It's about humility, discipline, and the ongoing art of seeing the signal amidst all the noise.
Well said.
Now, here's a final thought to leave you with. Consider how this passionless barometer of the stock market, which reflects all known information and tries to forecast the future, how might that also serve as a powerful metaphor for other complex systems in our world? Think about technological adoption curves, how new tech spreads, or shifts in consumer behavior, even cultural trends. What other averages or indicators might be out there silently signaling what's coming next, if only we knew how to observe and interpret them correctly? What lines might be forming right now in areas you're tracking? Something to mull over until our next deep dive.